Global equities finished 2013 on a strong note, rising 1.9% in December for gains of 27.4% for the year, or 19.3% in euro terms, as the economic backdrop continued to improve and central banks again committed to keeping interest rates low for a considerable period. Eurozone bonds fell 0.9% in December, as yields rose in response to the Fed's decision to begin QE3 tapering, and were up 2.4% for the year as peripheral yields fell on better economic news flow and increased financial stability due to the backstop provided by policy initiatives. The Fed surprised markets when it announced that QE3 tapering would begin in January, with the level of asset purchases conducted by the Fed being reduced by $10 billion per month to $75 billion. Equities reacted positively given the new guidance provided by the Fed in relation to interest rates, when it indicated that rates would be maintained at current levels well past the time that unemployment falls below the threshold of 6.5%, which it had previously suggested would lead to a review of interest rates. Investors also focused on the improving economic fundamentals, which contributed to the taper decision, as the Fed justified the move by the growing underlying strength evident in the economy. Reductions of similar amounts are expected in coming months, so that QE3 is likely to end in the fourth quarter of the year, after total purchases of around $450 billion through 2014 as a whole. The rally in equity markets from the lows of early 2009 has been relatively long in duration and magnitude compared to rallies in previous cycles. But the context of the current rally must be taken into account in terms of the extent and depth of the financial and sovereign crisis at the low point in markets when financial systems across the developed world were close to collapse. The recovery to date reflects a gradual return towards normalization following some extreme circumstances at the height of the crisis, and thus the recovery can be expected to be longer and greater than is typically the case when markets recover from their lows. Despite strong gains in equity markets last year, fundamentals suggest equities still offer upside, while history also shows markets are capable of providing further gains even after a year of strong returns such as the one experienced in 2013. In the US, which accounts for approximately half of global equity markets, since 1960, in the years immediately following those in which the total return from equities has exceeded 20%, the average return in the following year has been 12%. Similarly, since 1945, the average duration and magnitude of gains following the attainment of new all-time highs is 2.5 years in length, with further gains of 59% or 18% annualized after the old all-time high has been exceeded. Thus, on the basis of history, despite reaching new all-time highs and generating strong returns in 2013, US and global equities are capable of generating double-digit returns in 2014. Equities still offer upside in 2014. Support is provided by an improving global economy which underpins earnings. Monetary stimulus remains supportive even as the Fed begins to taper QE3, with central banks committed to keeping interest rates low for an extended period, while further policy initiatives are possible from the ECB and Bank of Japan. The improving fundamental backdrop should enable valuations to move higher, as has happened in previous cycles, particularly as we currently appear to be only in the mid-phase of an investment cycle. The reduction in global investment tail risks over the last 12 to 18 months, and the relative attractiveness of equities compared to alternative investments such as bonds, has also contributed to significant flows into equities for the first time in a number of years. While equities are expected to move higher in 2014, returns, however, are likely to be more modest than was evident in 2013. European bonds are expected to see marginally negative returns as pressure on yields remains to the upside due to the improving economic backdrop and reduced levels of asset purchases by the Fed.